Hello and welcome to our special programme on September's US jobs report. We're live on the IG platform on Facebook, on YouTube and on Periscope. With less than 5 minutes to go until the data release, let's recap the expected numbers. The headline non-farm payrolls figure is expected to come in at 185,000. According to 70 economists polled by Bloomberg, the range is between 125 and 245,000. Now, we'll also be keeping a close watch for any revisions to last month's reading, which came in at 201,000. That was above analysts' expectations. Meanwhile, September's unemployment rate is forecast to improve to 3.8% from 3.9% in August. And of course, that all-important average hourly earnings figure is seen softening slightly to 0.3% from 0.4% last month. The year-on-year figure is expected also to fall modestly to 2.8% from 2.9% in August. Now let's have a check on the European markets ahead of the data release. As we head into the final hours of trade for the week, the markets look set to close out the 5 sessions in negative territory amid broad-based declines across global markets. Rising bond yields in the US appear to have spooked equity markets amid concerns of a rotation trade from equities to bonds. As you can see, the FTSE 100 and the German 30 cash there both down by around 0.75%. The France 40 cash, that of course is the CAC, down by around 0.5%. Now let's check in on how trade is shaping up on the IG platform in the United States, with just over an hour to go until the start of the session. Stateside, as you can see, the major averages in the red there. The US Tech 100 cash, that of course is the Nasdaq, leading the declines, following on from sharp losses yesterday where tech stocks hit 15-month lows. It's down by 0.34%, and this after the S&P 500 and the Nasdaq saw their worst sessions in about 3 months on Thursday. Meanwhile, the VIX Volatility Index jumped as much as 30% yesterday in the session. Now let's have a check on the Forex markets on the IG platform. Sterling is the real outperformer today, up by 0.25% against the US dollar. Meanwhile, Eurodollar trading lower, the dollar slightly higher against the common currency in Europe. Meanwhile, USD, JPY, the yen there pretty much flat. But of course, remember, a lot of market participants likely taking to the sidelines ahead of today's all-important jobs numbers due in just a few minutes. Joining me now for a quick first word as we await those numbers is Peter Dixon, Global Equities Economist at Commerzbank, and Chris Beecham, IG's Chief Market Analyst. Thank you so much to both of you for joining us. Now, yesterday we had the ADP Private Employment Report, and we also had the ISM Non-Manufacturing PMI. That was the strongest reading on record since 2008. The ADP also beating expectations. So does that set us up for a strong print today?
Well, you would think so. I mean, certainly the anecdotal evidence clearly indicates that we're looking at a decent number. But of course, around this time of year, we've got the hurricane season to contend with. It's likely that the hurricanes that hit the US last month would have taken somewhere between 20 and 40,000 off the actual numbers. So that could be a downside risk. But I think that the anecdotal numbers, the ADP and the ISM, suggest that whilst the consensus expectation is focused on 180 to 185, there may be some modest upside risks to those numbers. And
if we look at the average hourly earnings portion of the report, is it normal to see wages slow in terms of growth at this point in the cycle?
Well, I mean, it's a 1 month effect. I think the general trend in wages has clearly been upwards. Wage inflation has been picking up for the last 3 or 4 years. It's a slow gradual process. We're not quite at 3% yet, but certainly I think it's all of a piece which suggests that the US economy is, in Jay Powell's words, going through an extraordinary phase.
Now, I want to ask you about the Fed a bit later, but Chris, where are you looking for the market reaction today?
Well, I think the question is how much we've baked in a stronger number here with that ADP figure. Now, the correlation is debatable, but certainly I think people have now nudged their expectations higher and probably above what the average is currently around that 185,000 mark. So it would need to be a hefty surprise, I think, to really give a lift here. You've seen actually some steady buying of euro-dollar since around 10 o'clock this morning, which suggests that perhaps we might have not quite prices in entirely, but perhaps there's not quite the huge upside surprise. Again, I think it's the wage number that should be the one that delivers the capacity for that.
All right, now let's recap the numbers once again before bringing you the data release. 185,000 is the forecast in September. 3.8% for the unemployment rate, 0.3% for average hourly earnings. Now let's check in and see if we can get those numbers for you. 134,000 for the headline non-farm payrolls report, so a miss on expectations for 185,000. Meanwhile, average hourly earnings coming in line with expectations, 0.3% month on month, 2.8% year on year. So that's in line with expectations for month on month and year on year. Meanwhile, the unemployment rate better than expectations, 3.7%, falling from 3.9% last month and ahead of forecasts for 3.8%. Let's check in on the market reaction now. We can see there was an initial spike in euro-dollar higher, but now actually it's moved back lower. So we're pretty much flat in terms of the market reaction. There seems like there was a knee-jerk reaction to the downside with the dollar, but it looks like it's given back some of those declines. Chris, let's bring you in here. What are you seeing on the charts?
Yes, exactly. That big spike higher in euro-dollar. Well, relative on that 5-minute chart, of course, we're seeing it push 115.30. But I think if you look at, obviously, the first reaction, the old cliche is the first reaction is always the wrong one. And that's probably what you're seeing here, that spike higher. But then you can see reasons for positivity. It is, as we were saying, that the 1 month is the outlier here. There are reasons to perhaps expect this to drop. So once again, another death blow, I think, to that idea that ADP is anyway a useful predictor, really, for those non-farms numbers.
Now, I just want to bring you up to speed with one other thing, which is the fact that last month's number was actually revised higher to 270,000. So it's a miss on this month's reading, but it's actually a revision higher to the previous month's reading, which actually is probably a better indication of where we are. What do you make of that mix of numbers, Peter?
Well, I think you're quite right. It probably is a better mix because, I mean, obviously the payrolls number as we see it is a first cut estimate, which, you know, comes in just after the end of the month, and it obviously determines market sentiment. But I think in terms of what it tells us about the US economy right now, we should treat it with a pinch of salt. I think looking at the the relatively low number that we saw, certainly compared to expectations, I would say that there's probably a large element of hurricane-related activity, wiping something off those numbers. I did point to some downside risks to that. Until I've seen the details, I think we should treat it with a pinch of salt. I rather think that we'll see a rebound next month as this effect is reversed.
Now, if we think about the movements in the US dollar at the moment, we've been seeing the greenback move higher over the last few weeks. It seems like the dollar bulls are really back in control. Do you see that currency moving higher from here?
I think the upside for the dollar is probably quite limited. I mean, to be fair, the market is really, I think, only now beginning to price in what the Fed has been telling them for some time. So, maybe there's a little bit of upside there, but not a huge amount. And I rather think this 115 level is proving a bit of a struggle to get through. I mean, Chris can maybe give us a bit more insight on the chart front, but it's very difficult from a fundamental perspective to imagine that we're going to go, significantly higher on the dollar from here.
So, Chris, in terms of the market reaction, are we seeing any moves into any safe haven assets at all, perhaps with this miss on the headline non-farm payrolls report, or are we seeing any further movement in the dollar? You're
seeing dollar strength, really. If you look again, perhaps at dollar yen, to slice it a different way. And again, you've not just got a revision to the last month's number, but July has also been revised higher as well. So really, what the market has taken away with one hand, and the immediate number it's given back with those July and August numbers. That's why people are still content on the face of this to continue buying US dollar, and that's what we're seeing here. Dollar yen back above 114 and happy to do so. I think it makes sense, really. The labour market's moving in the right direction. The wage growth, okay, it's not stellar, but it is good enough, I think, to keep people positive on the outlook here. Remember, we've seen a big shift to net long positioning US dollar. I don't see any reason why that would start to change off the back of these numbers.
Now, Peter, let's talk about the treasuries, because that seems to be the key theme for the market, at least this week, and that's what's driving some of the sell-off in equities that we've been seeing over the past couple of sessions. The 10-year yield on the US Treasury rising above 3.2% for the first time since May 2011. Do you think we could be coming to the end of the 30-year bull market for bonds?
Well, that might be a little bit overstating it, but certainly I think that we're going to find, I think, that as the economy gains momentum, as the Federal Reserve continues to push rates up, possibly above the long-run equilibrium level of around 3%, and as markets start to sort of factor that in, then I do think there's scope for the 10-year yields to drift higher. That said, I mean, given the magnitude of the moves that we've seen this week, I wouldn't be at all surprised if we dip a little bit first before yields start to grind higher.
So you mentioned the central bank, the Fed, of course, it raised rates for the third time this year in September, and it looks like December's very much on the cards. We're at the 8th rate hike of this cycle. But I think the real question is how many more rate hikes, particularly into next year and the year after, is the US economy going to be able to take?
Well, that's a good question, isn't it? I mean, I think we'll get a couple next year. I think the Fed's talking about 3. But I think what's interesting is that, given that the Fed has given us an awful lot of guidance over the course of recent years, I guess, they've spoon-fed us. Over the course of the next few months, or certainly beyond the year end, they're going to make these decisions based upon the data. It'll become a much more data-dependent process. And I think, therefore, that we might start to see a lot more volatility in market pricing as different players see it in different ways. But I do think that once you start to get the funds rate starts to nudge significantly above 3%, which could put pressure on the bond market, that's the point at which equity markets could begin to look a bit more wobbly, especially given where valuations are right now. The economy will be okay, I think, but it's the markets I'm a bit more concerned about.
Well, we have heard several economists pointing to a potential US recession as soon as 2020. So is there a risk of a Fed-induced recession at all if it moves too quickly? If
it moves too quickly, yes, I think that's absolutely right. But I mean, I think a lot of people have been talking about this potential inversion of the yield curve as a recessionary signal. Again, we're not quite there yet. We dip in and out of these of this territory almost from week to week. But certainly, I think the Fed is very well aware of the fact that if it were to tighten rates too far, it could bring about an end to this expansion, either a market expansion or indeed an economic expansion. And you know what they used to say, what Rudy Dornbush used to say, the expansion doesn't usually die of its own accord, it's murdered in its bed by the Fed.
Doesn't die of old age.
And certainly this is the kind of scenario we're facing now.
It's very unfair on the Fed, I think.
Now, Chris, I want to get your view on what's happening in terms of the markets, because we saw the tech sector hit 50-month low yesterday, but that's after that sector has been propelling US equities to continue record highs for some time now. So perhaps do you think we could be coming to the end of, or at least approaching or past even, the peak for market valuations? And there's been a lot of concern about the fact that gains haven't been broad-based and it has been very concentrated in the tech sector. So sort of where do we go from here, I guess, is the question.
You see that in every rally over the past 20 years, at least, if not going back even further into time. Most of the gains come from a small number of stocks. It's a feature of market indices. It's how they work. I don't think we should be concerned unduly. What we've seen in the last few days, yes, is a bit of a shock to the system, and perhaps we're having perhaps a mini version of what we saw back in January and February with that sudden shock to the system in terms of inflation and yields. But I don't think it imperils the overall move higher in equities generally. Reasons to be sensible: you hike rates in an improving economy. Equities, yes, they look a tad less attractive from the back of these treasury yields on a relative basis, but overall it still makes sense to follow the path higher, particularly in these strongest performers. And I think this kind of weakness you get over the last couple of days in the Nasdaq, even the S&P, it's entirely makes sense after recent strong gains, and we should expect it to move higher.
So are there any technical levels that we should be watching for on the Nasdaq, do you think?
Well, let's take, recent supports come in 73.80 in the very short term. You can see we have been practically moving in a straight line since June, so a short-term weakness down towards 7,200 would seem like quite a dramatic move. It would not take us take much of a bite at the recent trend. I think it would be a nice little pullback. So we should be looking for these kind of 7,200 level maybe in the short term before it starts to move higher once again.
I want to switch focus slightly. Peter, next week US earnings season kicks off. Can't believe it's come back round so quickly. Next Friday we get the major banks, including JP Morgan and Wells Fargo. I'm wondering what you'll be looking out for there, what the market should be watching for.
Well, I think in terms of the earnings season, I think most of us are expecting another set of decent numbers. Certainly with regards to market trading activity, it's been a reasonably decent third quarter. So again, I think that should give the banks a little bit of a tailwind. Obviously, the recent turnaround in the bond market might change things, but that's unlikely to figure in the Q3 numbers. So I think we're set fair for a reasonably decent earnings season overall, primarily because we're still getting the benefit of the tax cuts which were introduced at the start of the year. That's good news. But I do suspect that as time goes on, that effect will fade. But let's not spoil the party yet. Let's enjoy some good Q3 numbers while we can.
Now, another major market event on the horizon is, of course, those US midterm elections. Now, typically, markets tend to catch a bid in the aftermath of this vote. But given the fact that we've had a lot of headwinds already, you already mentioned those tax cuts, and we've seen a major rally ahead of those midterm elections. Do you think perhaps this time it could be a little bit different?
I think to a large extent, markets tend not to get too excited about midterms unless we see dramatic change in outcomes relative to expectations. I think the likelihood is this time, we'll start to see a bit of a rebound in the Democrats' performance. We could get a hung Congress, as it were, which could make life very difficult, I guess, for the Republicans going forward. That might cause markets to maybe pause for thought a little bit, because it will mean that the president is less able to fulfill his agenda. But to be fair, he's already given the markets what they want in terms of a tax cut. So I rather suspect, from a market perspective, the politics probably won't play much of a role over the course of the next sort of 8 weeks or so.
All right, now, before letting you go, let's have a quick recap of the numbers. It was 134,000 for the headline figure versus expectations for 185,000. So that was a miss on the headline number. But remember, the previous month came in at 270,000 in terms of its revision. So that was actually revised higher, stronger for the previous month, weaker for this month. Meanwhile, average hourly earnings coming in bang in line with expectations, and unemployment slightly stronger than expectations. 3.7% for the unemployment rate for September versus forecasts for 3.8%. Now, let's have a quick check on the markets before we conclude this program. As you can see, losses really accelerated since before the number. The FTSE 100 down by more than 1%. Similar losses for the German 30 cash. That, of course, is the Nasdaq, down by 1.1%. And the France 40 cash losses also greater now, 0.8% to the downside. Let's now have a look at US equity markets as we approach the market open. The US Tech 100 cash, the Nasdaq down by nearly 0.5%, leading those losses following the sell-off in the tech sector we saw yesterday. And now let's have a look at the Forex markets before letting you go. The dollar has in fact moved lower now, so cable is up a bit now, less than it was before. So the sterling giving back some of those gains. Euro dollar down by 0.2%. So the dollar is indeed pushing higher there. There we can see euro yen pretty much flat. Thanks so much to my guests, Peter Dixon, Global Equities Economist at Commerzbank, and IG's Chief Market Analyst, Chris Beecham. Thanks so much for watching this special programme on the US Jobs Report. I'm Victoria Scholar, and remember to find me on Twitter for more updates. I'm at VictoriaS_IG. See you soon.